there's just so many great things that are happening for public REITs across almost all the property types today, where we're having growing dividends at the same time as being on the cusp of accelerating earnings. The valuation looks pretty fair, especially relative to equities. They look extremely undervalued relative to the historical averages.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. Today I'm pleased to welcome Matt Werner back to the podcast. Matt is Managing Director and Senior Portfolio Manager at Chilton Capital Management in Houston and a seasoned expert on REIT investment strategies. Matt, thanks for joining the podcast again.
Thanks for having me.
Matt, at the outset, I wonder if you could put things into context and talk a little bit about how today's macro operating environment compares with other periods of volatility and uncertainty for commercial real estate that you've experienced. And also, is there a potential upside to uncertainty?
Yeah, that's a great question. It's certainly been a lot of volatility recently with some exogenous events that personally I don't think will have too much of a lasting effect on real estate. It does take me back to some other periods where there's been a lot of noise in the headlines about real estate or the economy that have actually proven to be excellent times to invest in commercial real estate. The first one that comes to mind is in 1999 when tech was going to the moon and REITs were a forgotten asset class while they were experiencing pretty good fundamentals. And it turned out to set off one of the great sort of 7 or 8 years of REIT investing that we can recall. And the uncertainty at the time was more on what was happening with the crash in tech stocks and how that was going to affect the economy, while the fundamentals for real estate were actually pretty good. Other periods that come to mind that occurred during my career, which started a little later, I can think of the taper tantrum in 2013. We had a rate hike in 2018, where again there was concerns about interest rates and what that was going to mean for valuations, which is understandable because REIT NAVs and what their assets are worth in the private market are certainly something that all investors need to follow. And that was part of the uncertainty with that. But when you just take a step back and look at the supply demand, and I think and simplify REITs as an asset class, historically that's been a good comfort zone to be in, to say I have the confidence to invest today even if the valuations are sort of in flux. And so when I think about what's happening today, and if you think about really the past 12 months, or you can even go back to the start of the rate hike cycle back in 2022, the fundamentals have been quite good. Now, they were decelerating from some record numbers in 2021, which was somewhat of a bounce back from a pullback in 2020. But the fundamentals have been good. And I think hearing from the CEOs and CFOs on earnings calls and speaking to them at conferences, the on-the-ground results that they've been able to put up and the responses from their tenants is especially in certain property types where they need the space and there's not enough being built, and that leads to higher occupancy, and that leads to higher rents. I've heard some analogies from CEOs saying maybe the next year it feels very uncertain, but if you look out 2, 3, 4, 5 years, the environment looks really good. And that's the way I feel today, with very low new construction across pretty much all property types in an economy that may have some hiccups because of some exogenous events and uncertainty about interest rates. But we do have confidence to invest today that the supply-demand environment looks quite good when you can maybe take your crystal ball out a little further than a day or month, a quarter, and look out more like in 2, 3, 4 years.
From what you're saying, it really does sound like REIT performance is holding up pretty well in this current climate.
Yeah, I think it's been pretty resilient for something that's had some negative headlines with being tied to interest rates. And I do think that the amount that REITs have been following moves in the 10-year maybe is discouraging for someone who's looking more for a steady Eddie environment. And I would love to know what the 10-year treasury is going to be a year from now. to make an assumption of what valuation should be and whether today they do look really inexpensive or not. But looking back over the past year, we've been in actually a pretty tight-ish range between 3.6 on the 10-year and 4.6. We got a little close to 5 for a little while, but that doesn't have that big of an effect on REIT earnings. And again, if you can have confidence in the rent growth and in the occupancy growth, then the valuations should take care of themselves. And I think especially when you compare it to maybe some other asset classes, if I could put on a hat of an asset allocator, where I do think there's a lot more uncertainty around your traditional equities that may have a much sharper effect from things like tariffs or a mild pullback in the economy or changes in job growth assumptions. These are companies with mostly long-term leases. And as long as you believe in the long-term growth in the U.S. economy, then they're going to perform very well. And you can spend hours and hours trying to come down to the penny of what you think these properties are worth and what someone should be willing to pay for them. But when you just look at the trends of earnings growth, it seems to be based on the supply and demand that we're going to be in a pretty nice environment of accelerating same-store NOI growth, which should lead to accelerating FFO and AFFO growth as well.
And Matt, would you say investing in an active REIT strategy really makes sense right now? What are some key reasons why REITs screen attractive? You've mentioned some of them already, but any additional?
Yeah, there's this volatility that's come from the uncertainty. I think is a perfect environment for active REIT strategy because we're able to take advantage of things that we think are selling off more than they should or trimming things that maybe are outperforming our expectations. And so we've been pretty active in our strategy. And when you think about some of the ones that have underperformed the most, it hasn't been anything that's been crazy to theorize. The tariffs having a bigger effect on industrial, for example, that makes sense. And so when you have an active strategy and the market kind of makes sense in terms of how it's reacting to the news, it does make for a good environment for active strategies, especially as we look to get into new names. And then we can make our decision on, do we think the tariff, has it overreacted to it? And do we think the tariffs will be easing or have less an effect than what the market has expected? And why REIT should screen attractive, I've mentioned several things already, but I do think that there is not that many times in REIT history that I can think of where you have a secular growth story, and real estate's one of the oldest investments that you could do going back thousands of years. And it's not often that we get a perfect setup of where we see growing occupancy and growing rent to double-digit numbers. And we have that today with data centers and the AI boom that's happening. And we have that today in senior housing where we had way too little supply built and no relief on the horizon from new construction, and which is leading to higher rents, and we're getting more relief on the expense side as well. So two pretty big secular growth stories happening at the same time in our quote unquote boring asset class, I think is a great reason for the casual investor to get interested in public REITs.
What are you seeing when you look at REITs compared to private real estate? Are there certain themes that are emerging there?
Yeah, I think when you look back on the past 10 years, private real estate has been a relative winner. They should do really well when rates are low because of their higher leverage, and especially if rates are going lower or staying low. And they were able to raise a lot of capital, and the early ones in particular, especially if you were able to sell out before 2022, produced great returns for their investors, better than public REITs because of the higher leverage and the magnified effects that go along with that. And now I think that environment has changed with the higher 10-year treasury yield, much higher borrowing costs. It's difficult to make that bet that we're going to get back to really low rates today. And for someone that wants to put a deal together at 50, 60, 70% leverage and buy something at a cap rate that is at or maybe even below what the borrowing rate is, your free cash flow is going to be not very attractive. And you're really just hoping for lower cap rates in the future unless you really think there's going to be rent growth. And I think if you can compare that side to side with public REITs, that scenario, if there is this rent growth and occupancy growth that's going to lead to same store NOI growth above expectations, the public REITs are going to do really well. And they don't need that lower rate environment to be successful because of the much lower leverage, about 30% of gross assets. And that's also serves well for protection on the downside. They don't have to worry about big debt refinancing or having to put up more equity. I need dilutive impact to earnings from refinancing at some higher rate. REITs have been able to grow dividends in this environment and should continue to grow dividends in this environment. So, that flow of capital into private real estate and private REITs has certainly slowed, and I think should continue to slow. And the public REITs should be beneficiaries of that.
And are there particular REIT sectors that you see as particularly well protected in this environment? And how might that impact fund flows into the sectors?
There is a few, what I would call your non-cyclical sectors that I think have gained appreciation over the years, that some of them may not come to mind when someone thinks of what a REIT is, but we've mentioned data centers already. Cell towers is another one that should be doing the same, whether or not the economy is doing well or not. Healthcare, certainly with people needing to go to the doctor or needing to go for an operation and needing a place to live and get that care that they need as they have more people turning 80 years old. So those are necessity-based or non-cyclical sectors. And then maybe just one more that I think is maybe not as intuitive is that shopping centers are very well protected. They tend to focus more on the service tenants and necessity-based tenants. And there's no supply, or can speak to some other experts on what's actually happening on the ground. You could say there's negative supply from retail getting taken out of the pipeline. They're very well protected. And part of that, I think, has been validated with Blackstone's purchase of ROIC recently. And I think that shopping centers should receive a lot more attention from allocators as they come to see the very positive supply-demand dynamics.
What steps is Chilton taking both to shore up its own portfolio as well as to potentially benefit from these volatile market conditions?
Recently, we have been looking to add some value to our portfolio, or we've been able to outperform as the market's pulled back several times over the past few years. And when we look at the environment today, I think of office and some industrial names have really sold off. And when we think about, again, going out the next 2-3 years, being pretty confident that the economy is going to be doing just fine, we don't need them to get back to 2019 levels or 2021 levels for us to do well. We're buying some stocks at 50% discounts to where they were not long ago with fundamentals that aren't great. But we like that, where the bar has been set a lot lower, where you don't need to have 10% earnings growth. If you could just get flat earnings, then all of a sudden you can have the stock start to do really well and having somewhat of a reversion to what the long-term averages have been for earnings. A good example is that we bought Highwoods a few years ago, and I think the FFO today is lower than it was when we bought it, but the stock is up almost 50% when you include the dividends that we've received. And we see a few opportunities like that available. We've done pretty well with some recent IPOs. The most recent was SmartStop, was a new self-storage REIT. Don't particularly love the fundamentals in self-storage today with not as many people moving and buying houses, but the public investors got to take advantage of the need for capital that SmartStop had, and we were able to buy this at a pretty big discount to where the peers were trading. We look forward to hopefully more IPOs in the near term for REITs, because I think these private real estate structures do need new equity, and is a good amount that's available in the private market, but the positive attributes that REITs provide and the ability to raise new equity, get unsecured debt, and do it overnight, I think is attractive to a lot of private owners out there.
Matt, I wanted to ask you whether you see the current tariff-induced uncertainty as more of a short-term blip on the screen, or is it something that could potentially have longer-lasting implications on the real estate sector?
I think this is a blip on the screen for the public REITs. They're not importers of anything that they're selling. This, if anything, increases construction costs, which will further dampen new construction going forward. This is going to increase replacement costs or replacement values. Rents tend to follow those over time. So if you're a current landlord, then you're going to feel a lot better knowing that no one's going to put something up across the street from you, or if they do, their rents are going to be much higher than what you're charging, and that you can play off that. Again, I hope that this makes REITs screen attractive, especially on a risk-adjusted basis relative to other traditional equities that are not as locked into long-term leases and are much more vulnerable to changes in policy affecting near-term earnings. I think this is a great time to invest in public REITs, especially when you factor in the risk.
Excellent. And Matt, you've covered lots of ground, but anything else that you think listeners might be interested in right now?
I just think that the yield story is something that can get lost with where the 10 years trading and the proliferance now of private credit. And for someone who's going to say that I can get 5% on some corporate bonds or 10% from my private credit, I think REITs just are getting lost in the shuffle. And there's just so many great things that are happening for public REITs across almost all the property types today, where we're having growing dividends at the same time as being on the cusp of accelerating earnings. The valuation looks pretty fair, especially relative to equities. They look extremely undervalued relative to the historical averages. So a 4.25 yield that's growing at mid-single digits certainly would have sounded a lot more attractive when the 10-year was at 1 or 2. But I think that's going to do a lot better than locking yourself into a 5% on a corporate bond or even a private credit fund that says it's 10%. It could be a ticking time bomb to a default down the road that could turn that 10 into something in the single digits. So there's a lot of competition out there for investor dollars. And I think that public REITs just have a great story to tell, and just glad to be a part of the community that's trying to get the word out and highlight all the positive attributes that public REITs have to offer.
Thank you so much for your time today. That was great.
Thanks, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.